All right, today we're diving into one of the most, let's be honest, frustrating parts of the tax code, the medical expense deduction. We're going to pull apart Internal Revenue Code Section 213 piece by piece and expose what's really a statutory gauntlet. The reason why most people can't just deduct their full medical costs. Let's get right into it. So here's the question that every tax professional gets, and that just about every taxpayer has asked at some point. I had this massive medical bill. Why can't I deduct all of it? You know, people expect this dollar-for-dollar tax benefit, but the reality is so much more complicated. The truth is, the tax code is specifically designed to stop that from happening, and understanding why is the absolute key to navigating it.
And this quote, it really just sets the stage perfectly. You have to get this in your head. Section 213 is not about making your regular doctor's visits cheaper. Think of it as a safety net. It's designed to kick in and provide relief only when medical costs get truly unusually high compared to your income. It's catastrophic insurance, not a healthcare subsidy.
So to really get to the bottom of this, here's our game plan. We're going to start with the high bar to even get started. Then we'll deconstruct that infamous AGI floor. We'll look at the history behind it, the legislative tug of war. Then we'll get into what even qualifies as medical care, cover some very specific rules, and then of course wrap it all up with some real-world strategies. Okay, first up, the deductions high bar. It's so important to think of IRC Section 213 not as a simple yes or no allowance. No, it's more like a series of demanding filters. An expense has to pass through every single one of these tests before a single dollar can even be thought about for a deduction.
Now, let's get to the real heart of the matter, that 7.5% floor. The core of this whole gauntlet is written right there in the text of Section 213A. It's actually one sentence that sets up the three primary filters that we're about to break down. These are the filters that, step by step, shrink and, let's be real, often completely eliminate any potential deduction.
Okay, let's break these down. Filter number one is the timing filter. The expense has to be paid during the tax year. It doesn't matter when you got the service, it's all about when the money left your pocket. It's a cash basis rule. Second, the net cost filter. The expense has to be uncompensated. If insurance or anyone else paid for it, it's out. And third, the big one, the quantitative threshold. Your total expenses have to exceed a certain percentage of your adjusted gross income, or AGI. And what is that number? Well, thanks to the Consolidated Appropriations Act of 2021, it is now permanently set at 7.5%. This right here, this is the single biggest hurdle. This is what ensures that only those expenses that are really truly a burden relative to your income can ever hope to generate a tax benefit. This table shows you exactly how that AGI floor creates what we call dead space. Let's just walk through it. Say a taxpayer has an AGI of $100,000. Well, their floor is $7,500. What that means is the first $7.5 grand of their medical bills gives them absolutely zero tax benefit. It just vanishes. So if they have $8,000 in qualified bills, only the amount above that floor, a measly $500, is even potentially deductible. And even then, that $500 has to compete with the standard deduction. Now, you might be wondering, where did this 7.5% number even come from? Well, it wasn't just pulled out of a hat. It's actually the result of decades of legislative back and forth, this constant policy tension between needing to raise revenue and wanting to provide some relief for people with high medical costs. Let's just trace the history really quick. Before 1982, the floor was a much lower 3%. Then TIFRA in 82 raised it to 5%. The Big Tax Reform Act of 86 brought it up to 7.5%. Then the Affordable Care Act hiked it all the way up to 10% for most taxpayers. The TCJA brought it back down to 7.5% temporarily. And finally, the CAA made that 7.5% floor permanent, which at least ended years of uncertainty for planners. Okay, so we've been talking a lot about the numbers, the quantitative stuff. But before an expense can even face that 7.5% floor, it has to pass a qualitative test. It has to meet the very strict definition of medical care under Internal Revenue Code Section 213D. And here it is, straight from the code itself. You got to pay attention to the specific language here: diagnosis, cure, mitigation, treatment, or prevention of disease. This is the legal yardstick that the IRS and the courts are going to use to measure every single expense you claim. So, what this really boils down to is a critical distinction between treating a diagnosed disease versus just promoting your general health. For instance, a weight loss program prescribed by a doctor for diagnosed obesity, that's deductible. A gym membership just to stay in shape? Nope. Prescription drugs are in, general vitamins you buy at the store are out. The rule of thumb is the expense can't be merely beneficial to general health.
All right, now we're really going to get into the weeds because the tax code is just full of these special rules and inflation-adjusted numbers for very specific, often complex types of expenses, and you really need to have a granular understanding of these. Take long-term care insurance premiums, for example. For 2025, the amount you can deduct is not unlimited. It's strictly capped based on the taxpayer's age. It ranges from just $480 a year for someone 40 or under, all the way up to $6,020 for a taxpayer over 70. Capital improvements. Now, this is another really tricky area. Let's say a client needs to install a $20,000 elevator for medical reasons. They can't just go and deduct the full 20 grand. No way. The deduction is limited to the cost of that improvement minus whatever value it added to the home.
And here's the simple formula for how that works. But here's the crucial part. The burden of proof is on the taxpayer to get a professional appraisal. If you don't have one, the IRS can just argue the home's value went up by the full cost of the project, which, of course, completely wipes out the deduction.
And even driving to the doctor's office is limited. For 2024 and 2025, the medical mileage rate is just 21 cents a mile. And that only covers variable costs, like gas and oil. It doesn't cover insurance, depreciation, none of that. And if you need to stay overnight for care, the lodging is capped at a measly $50 per night per person.
Now, under Section 213C, there's some really important rules for decedents. Bills paid by the estate within a year of death can actually be claimed back on the person's final 1040. But, and this is a huge but, there's a critical trade-off. The executor has to make a choice, and it's irrevocable. You can't deduct those expenses on both the final income tax return and the estate tax return, Form 706. It's one or the other.
Okay, so we've dissected all these complicated, tricky rules. The real question is, how do we use them strategically? This is where really understanding the mechanics lets you do some effective tax planning.
Probably the most powerful tool you have comes from that simple paid rule we talked about right at the beginning. And this is all thanks to Revenue Ruling 7839. Here's the magic trick. Charging a medical expense to a credit card counts as paid in the year the charge is made, the year you swipe the card, not when you actually pay the credit card bill. You see how powerful that is for year-end planning?
And that leads us right into the bunching strategy. Think about it. That AGI floor resets to 0 every single year. So if you spread your expenses out, you're basically guaranteeing you get 0 deduction. But by strategically grouping elective things, orthodontics, maybe some non-urgent surgeries into a single year, you can push that total over the AGI threshold and actually unlock a real deduction.
So let's just run through that whole gauntlet one last time. You start with the full bill. First, you have to subtract any money from insurance. That's the net cost filter. Then you subtract anything that's not qualified, anything for general health, the qualitative filter. Then you reduce any of those special items, like the capital improvements, and only from what's left over do you subtract that final quantitative filter, 7.5% of your AGI. Whatever tiny amount survives that whole process, that's your deduction.
Which really brings us to our final question to think about. When you consider this incredibly high bar, all these hoops you have to jump through, is the medical expense deduction really an effective safety net for people with truly catastrophic costs? Or has its complexity created something of an illusion for the average taxpayer? It's a really important policy question that the design of Section 213 just forces us to confront.